Afternoon, everybody. Thanks for taking the break out. Now, I know it's quite normal in these situations for people to forecast the future, but I'm not very good at forecasting the future, so I'm not going to do that, despite the title of my talk. So I do apologise in advance, but get used to it in this industry. People tend to let you down after the initial marketing blurb. What I'm going to concentrate much more on is explaining, in as clear a way as I possibly can, why we are right now where we are. And I'm also going to drift into making some potential forecasting type looks more at the economy than the markets. So first of all, I'm going to concentrate on where we are today, why what's happened has happened, and what the most important aspect driving all that is. You'll note from my background that I'm more of a macro guy than anything, so I'm going to be looking at the top down, and QE is going to feature prominently. So the first thing I want to draw your attention to is that since, even before the crisis, but certainly since the crisis hit, although the fund managers won't necessarily tell you this, the stock market has performed almost exactly in line with, say, the US stock market. This is the FTSE All-Share and the S&P 500. And you can see that getting your currency call right is much more important necessarily than deciding which stock market to be in if you're looking at developed world stock markets. Now, both of these markets have performed extremely similarly for extremely similar reasons. They both got hit by the financial crisis, and both countries' solution to the financial crisis was very similar. QE and the magnitude of QE as a proportion of GDP was also pretty similar. But what you will notice is that something very interesting has happened in about the last 12 months. In the last 12 months, the Americans are busy talking about their bull market and how much further it'll go. But our market has kind of gone a bit quiet and a bit flat. Our market is the blue one. The FTSE All-Share is the blue line, and the S&P 500 is the purple line. Now, what's the difference between the US and the UK, particularly over the last 12 months? Well, the most important difference between the US and the UK in the last 12 months is, of course, they continued to do QE, and we stopped. We stopped, in fact, at the end of 2012. But QE tends to have about a sort of 12-month lag. So basically, the effects sort of fall out from more like sort of mid-2013, and if you're the economy, from more like the end of last year than that. But as you can see, this is the most important feature to explain. Why is their market still going up? They're still doing QE. Why is ours no longer going up? Because we're not. And by the way, that also explains currency. Why is sterling being so strong? Sterling has been strong recently because we stopped doing QE. What QE does is it dilutes the currency. It creates more supply of sterling than there is demand because we're artificially creating that supply. And that means that the value of the currency goes down. Since we stopped doing QE, we've stopped diluting sterling, and sterling started to go up. So if you ever look at what QE does, this is looking at QE from a government bond point of view. This is the most important impact it does. And as you can see, again, our gilt yields and the US Treasury yields have moved almost exactly together. But more interestingly and more importantly, look how they've moved with QE. QE makes bond yields go up. In other words, it makes bond prices go down. Now, we're always told that QE makes borrowing costs go down, makes it cheaper to borrow. That's one of the reasons they did QE. And yet the evidence is there right in front of your face. Every time we do QE, bond yields go up. The cost of borrowing goes up. The bond market doesn't like it. It doesn't like it because it's inflationary. And the bond market doesn't like things which are inflationary. It likes recession and deflation. But as you can see, QE is bad for bonds. QE is good for stocks. If you're going to take your money out of the bond market, where are you going to put it? You're going to put it in the stock market, which is where we go if things are more inflationary. So as you can see again, during the enactment of the US 3 stages of QE, US stocks, this is NASDAQ, the S&P 500, and the Russell 2000s. It doesn't matter whether you look at small stocks, tech stocks, or big stocks. They all go up when there's QE. And look what happens with those horizontal red lines when QE stops. We know what happens when QE stops. The bull market in stock market stops. Because that's the driver. In fact, if you take away QE, there hasn't been any recovery in stocks at all since the crisis hit. So QE is 100% responsible for all the gains in the US stock market. Now, that's why all the talk about tapering is completely wrong. The market isn't worried at the moment about the prospect of tapering. The market loves the fact you're doing any QE at all. The market is going to be very worried, though, about the end of QE. So when tapering comes to its natural conclusion, which should be around about September, then we're going to find out whether the market has legs. And chances are it doesn't, but it takes about 3 months or so for the market to realize that. So you've probably got a good US market until the end of this year, but 2015 is going to be very tough unless they reinstitute QE. So what is QE doing? If it's good for stock markets, but bad for the currency, how much these things weigh each other out? This is looking at the MSCI between a whole bunch of different markets. The red line at the top is the US. The dark blue line at the bottom is Japan. Japan did no QE until recently. Look what happened to the stock market when it did. And the US did lots of QE. So this is what happens, is that it makes your stock markets go up if you do QE, and nothing happens to your stock market at all if you don't. But when we use the same currency, if we use common currency terms, suddenly all that diversification disappears. So establishing who's doing QE is very important. If an economy is doing QE, you want to sell their currency and their bond market and buy their stock market. And if they're not doing QE, then you want to hold the currency but not the stocks. So this tells you what you want to do. And looking ahead to Europe, for example, when Europe has to do QE, which I believe it will have to eventually, that'll be terribly bad for the euro, which has been surprisingly strong, but very good for European stocks. So these are what we sort of kind of know about QE. We know that it dilutes the currency, bad for the currency. We know it's stimulative, which means good for the economy, and is good for stock markets, but bad for bonds, who don't like a strong economy. And it's also good for property, because of obviously anything that's good for the economy. And that inflationary element is bad for bonds. So this is something which is very crucial for understanding general asset allocation during this environment. And so, as we sort of saw at the very beginning, this explains why the US and the UK's stock market performances have diversified. So the next question for us is, do we need any more QE? Is QE over in the UK, or do we need any more? Now, to understand that, we need to understand what QE is. QE is the artificial printing of new money. We normally make money in our economy through bank lending. When a bank makes a loan to you, you put the money in your bank account. That is a new bank deposit. And bank deposits are basically money. That's how we measure money. So if the banks aren't increasing lending, we sort of technically have an economy that needs QE. That's why I say that Europe will need QE, because bank lending is shrinking in Europe. So is bank lending recovering in the UK? The banks tell us it is. Certainly all the press say that. This is actual stock of UK bank lending since the crisis began, or actually after the crisis began. This is since around about the beginning of 2009. Now, according to the Bank of England, there's been no increase in bank lending. But I think you'll agree, if you look at the stock of bank lending in the UK, that's a bit of an understatement. There's been a very visible decline in bank lending. And this is why we needed QE. Because bank lending declined from £2.2 trillion to where it is today, below 1.85 trillion. And that drop of about 375 billion may sound like a familiar number to those of you who are students of QE, because it pretty much exactly replicates the size of QE to date. So what QE does is kind of refills the hole. It's not quite that simplistic, because some of this contraction of bank lending is overseas loans, and what matters to us in the UK is purely domestic loans, which is why we see that bank lending has led, or QE has led to money supply increasing. But before we get to there, what do we think about our banks? Have they finished contracting lending? Well, this is a sort of histogram of basically the losses that banks have made historically, and recently in orange, historically in blue, in banking crises. And you can see where we are right now. We're here. The cumulative losses that our banks have put through their P&Ls is about 8.5% of peak loans. That's actually less than a typical single country crisis, and is about the same as what we saw back in the 1990s. The US banks are already up at nearly 14%. So you can tell that the US banks have done significantly more work, probably are fixed, and that's why the US doesn't need QE, and why QE in the US is having such a stimulative effect on the stock market, etc. We have the easiest monetary policy we've had in 320 years. In fact, actually, it's 1/4 of the rates. Base rates are 1/4 of the level, their lowest level in that 320-year period. So we're literally off the chart in terms of how low base rates are on a long-term historical basis. And even in that environment, as you saw a couple of charts earlier, bank lending is actually, if anything, still falling. But you wouldn't guess it to look at the headlines. I've taken this one out of City AM from late January. But firms hold back as house lending rockets. And this goes on to point out that in December, the Council of Mortgage Lenders says that new mortgage lending was up 49% year on year. Of course, it's always a good way to get things to go up a lot, and let's start with a low base. So they're taking a gross figure and grossing it up. If you actually look at the net figure, net mortgage lending was up 1.1% in December. And this is what the net mortgage lending figure looks like. You can see we are still nowhere near to anything that looks remotely like a recovery, despite the fact that mortgage lending is the #1 growth area for bank lending. All other areas in bank lending are declining. So this blue line here shows bank lending for mortgages, and the purple line shows bank lending for all other purposes. So this is lending to companies, lending to SMEs, lending for consumer credit, any lending that isn't a residential mortgage. So as you can see, if there is any growth in bank lending, the banks want to direct your attention towards mortgage lending, because everything else is still in pretty much free fall. So with the lowest interest rates for 220 years, 5 years on from the crisis, we still have bank lending falling on almost all fronts, except for a little bit of PR around mortgages, which sounds to me like a bank sector that's trying to sort of pull the wool over your eyes and tell you that things are better than they really are. So what does QE do? Now, this is the relationship between bank lending and broad money supply. So normally speaking, they move together. Bank lending is the way we create new broad money. When bank lending fell, that dark blue line fell, money supply stayed up. And it stayed up because we did QE1. The gap between those two is 200 billion, and QE1 was 200 billion, so that kept it up. But the second bout of QE that we did, that pushed up money supply, even though bank lending wasn't falling. So if bank lending is not falling and you print new money, then instead of the new money neutralizing the contraction of bank lending, what we actually get is an increase in broad money supply here. So this gives us a surprisingly strong economy. Last year, we saw economic growth of 2.7%. Now, in April of last year, the press was still talking about triple-dip recession. So we didn't just have a really strong economy last year, we had a really strong economy that took almost everybody by surprise. Now for this year, even though last year took them by surprise, everyone's going for an even stronger growth rate. They're going for about 2.9% on average. The IMF, for example, is going for 2.9%. So is the OBR. Some things we're going to have even stronger growth. But what caused last year's growth? Well, we have a candidate, that big increase in QE. If we're not going to have QE this year, then we're not going to have that tailwind. If we don't have that tailwind, then it may be that we don't have that sort of recovery. Now, are there any signs that the economy already might be showing a lack of traction? This is the leading indicator, or at least the dark blue line here is the leading indicator. And that leads the economy by about 2 quarters. So I've lagged the economy back by about 2 quarters. And although the economy is still going well, the leading indicator already appears to be rolling over. Secondly, trade. Trade, both exports and imports, is actually contracting. So the growth rate of trade is contracting, even though the economy is still picking up. So basically, trade's not supporting the economy. The leading indicator isn't supporting the economy. As we discussed earlier, bank lending isn't growing, so that's not supporting the economy. The government's not supporting the economy because the government's trying to do austerity. So whilst the government's doing austerity, this is the relationship between the private sector savings ratio and bank lending to the private sector. And this shows that when the banks aren't increasing lending, then you can't, or they force effectively the private sector to increase its savings rate. So if no one's spending the money and we haven't got QE, what exactly is going to be driving this year's really strong growth? The government has this big gap to make up. This is government spending. This is austerity. You'll see the big drop in government spending that was austerity. If you can't see that, there's a good reason why you can't see that. But give them their due, bless them, they kept spending flat for a whole year. That was austerity. Now the big problem is, this is revenues. Now revenues basically have to catch up. And the OBR estimates, it assumes that revenues will catch up with spending by 2018. If that's going to happen, then tax revenue has to rise at about 5% per annum. So mansion tax won't be the last of the big new tax increases. The problem for the government is all the historical evidence suggests that when you increase the tax rate, the tax take goes down because people find ways not to pay it or just give up working, etc. So we've got a lot of headwinds here, and the main tailwind, QE, has gone. This has already been picked up in several things. This is GDP per, well, this blue line here is GDP, and you can see GDP is almost back to where it was pre-crisis. So you'll hear the press talk a lot about that and the politicians. But this red line, red bars, that's GDP per capita. And as you can see, GDP per capita was growing until the crisis. But since the crisis, GDP per capita isn't really much higher than it was in 2010. So there isn't really much of a recovery going on, except there are more people coming into the economy, and more of those people are working. But you'll notice they're not working very productively, and they're not being paid anymore. So the only increase in the economy is coming because we've effectively sort of, annexed Anglesey or something like that. We're just adding something else to our list. But as far as our list is concerned, we're not actually seeing any real signs of recovery. So since that was all a bit depressing, I'm going to leave you one positive. It's hard for you here in London, and if you come from London, you live in a totally different country to the rest of the country, especially when it comes to house prices. So imagine if you do come from London, you don't come from London. We're just going to look at the data rather than what you've seen in the newspaper. This is house prices as compared to the household post-tax income. So what are house prices compared to what people can afford to pay for houses? And we did have a big bubble in house prices. That's back in around about 2006, 2007, just pre the crisis. And house prices in the rest of the country, relative to the slow but steady rise of household post-tax income, have stayed flat or even gone down. Such that by now, 5 years on, the rise in household income has pretty much caught up with the decline of house prices, and the two are about the same. So given the fact that we're going to get an awful lot of stimulus, that there is a small amount of mortgage lending rising. It's the only area where the banks are keen to lend for technical reasons. But there is a chance that house prices outside of London can start to find a floor and pick up again. As I said, as far as good news goes, maybe not the most exciting bit of good news, but most of the news from the economy's point of view is poor. One last thought, though. Bad news from the economy's point of view is not necessarily bad news from an investor's point of view. If the economy is going to be weak, then it's much more likely this country is going to need QE. We already see that bank lending isn't picking up. We can already see that the growth rate of the economy may well run out of steam later in this year. And if that happens, then we may well need further stimulus towards the end of the year. If 2013 was all depression at the beginning of the year, and then surprisingly good news throughout the rest of the year, this year may be the exact opposite. Everyone's bullish on the economy now. No one's quite sure why, but what the hell. And we may get more depressing towards the end of the year, but that's when we might start getting talk about QE, and that's the time to start looking back at the stock market. But until then, I think the stock market in this country is going to be pretty quiet. Are there any questions? I think I'm inside my time. Just? Yes.
My question is, we had some very encouraging production.
Sorry. Yes, keep going.
It was the first inkling. I thought, maybe the economy might get better. There's some evidence that the economy is getting better, not just in the fake way, like house prices and, the QE effects on the FTSE. That there might be some substance through an improvement in the economy when you see that manufacturing is going up. And what's your comment on that? Its manufacturing figures.
Yeah, I'm not forecasting a recession. I'm just saying that everybody's falling over themselves to forecast that the growth rate this year will be stronger than last year. We've got a lot of positive sentiment. Most of the things you read in the press about recovery are actually PMIs, which are sentiment indicators. But production is picking up. You'll notice from the chart on trade that unfortunately, as far as exports are concerned, we're still not seeing any real recovery because of Europe.
I accept that, but exports tend to be lagging. But with the rest of the world in such a mess, and China potentially falling over this summer, don't you think that the UK, albeit the whole world's in a pretty bad situation, the UK is one of the best places right now because everybody else is in so much dog doo-doo?
Yes, the UK is very good right now. I'm stepping into that dangerous field of making a forecast about where we go next. And my concern is not where we are right now. Where we are right now is a sweet spot. We've just had a fantastically large amount of artificial stimulus from QE. We've boosted the nominal economy. A lot of that has been mismeasured as being real economic growth. That has improved sentiment massively. It's very hard to find any part of the economy where sentiment isn't positive. So we are in a very, very good spot. My problem is where are we going to be in 12 months' time? If we have this conversation in 12 months' time, what is the thing which is going to have helped our economy recover? Is it demand from Europe? No. Is it trade in general? Looking at the figures already? No. Is the leading indicator pointing upwards? No. Are we going to get an expansion of the nominal economy? No. Is it going to be government spending? No, because they're doing austerity, or at least they're supposed to be, and increasing taxes. So it's not going to be government. It's not going to be. Is it going to be the household sector? Well, there's no lending increase to the household sector except very nominally on mortgages. So there might be something from the household sector on mortgages, but it doesn't look huge. We've still got that great unused resource in the West, which is corporate spending. Why are corporates not spending? If you're an economist, there's a thing called the Ricardian equivalence. Ricardo was a British economist from some time back, a couple hundred years back, and he said the problem is that if people see the government stimulating the economy by borrowing, they're going to anticipate future taxes and they'll pull back on their spending, and therefore you won't get any real benefit. Now, that's supposed to be the household sector to do that. But it could be that the household sector, which is fairly constrained in terms of discretionary spending, isn't doing that, but the corporate sector is. So maybe the corporate sector in the US and the UK is looking at the state of government finances and saying, I can see what's going to happen. It's going to be higher taxes, so there's no point in me spending money right now on new capex.
I agree with you. What's worrying is the lack of investment, corporate investment, and what's happening in the education system, and it doesn't bode very well for the long-term future. However, what makes me laugh is that most FX dealers expect a base rate increase next year.
Yeah, well,
all the evidence is contrary.
That's why I thought it might be useful to look at the situation we're actually in rather than making any forecasts. If you just look at the situation we're in, you can see that base rate hikes, I think, look unlikely. I think we may even be getting to the stage towards the end of the year when people start going, where's the next round of QE?
Yeah, I agree.
Hello there. Is it working? Okay. What we see is, as I understand it, is we see falling productivity in the UK. We see wages coming up, and we see the pound rising. Those three things don't indicate a very optimistic prospect. One of the reasons for that, and maybe you can answer this, Jim, it's our exports equate to something like 20% of GDP. I think 10% in Europe and 10% outside generally. Whereas in Germany, they've got 40% exports. Is that partly because in this country, people find it easier to invest in low-risk property investments than in Germany, where property isn't such a big deal? Why is it we're not getting more investment into better productivity, into training, and innovation?
Well, that's a very big topic, but in a nutshell, yes. The question almost answers itself. If you create a stimulative environment and you give people very artificially low interest rates, they tend to find all sorts of very unproductive things seem to make sense to invest in. And often that's what causes the bubble before the breakdown. So you may think, for example, that buying a house and doing it up, you buy the house for £125,000, you spend £10,000 doing it up, but you sell it for 140. So you've made £5,000. Unless, of course, house price inflation during that period is such that you would have made the £5,000 anyway. You're just conning yourself if you think that all that industry and rushing around and paintwork, etc., had an effect. So this is what basically happens in an environment where interest rates are too low, which we had pre the crisis. We had all sorts of businesses which were actually not making any money. They only appeared to be because they kept refinancing at lower interest rates or were using, inflation, asset inflation to back them up. When we hit the crisis, therefore, maybe we should leave interest rates the same or even have them a bit higher to instill some discipline in the economy. This is what's called euphemistically the Austrian school. However, of course, that actually causes tremendous damage. Look at Ireland, who had it imposed on them. So we didn't do that. We lowered interest rates. And Mervyn King, at the time, talked about what he called the paradox of policy, which is if you make things not so bad in the near term, people might not believe they've got to change their ways, and they may carry on doing it. Well, we now are 5 years on with these super low interest rates, more QE than we actually need, which means that nobody's changed their ways. And some people are still buying houses and doing them up and thinking that's a genuine, productive pastime. So, yes, the problem that you have with not taking all your lumps early on is that you've left some nasty stuff to still have to deal with. But I mean, I think that's a 5 to 10 year problem. I'm still just talking about the next 12 months.
Jim, if I can ask you to maybe gaze into your crystal ball, very simple question. In relation to sterling strength versus the dollar and the euro. At the moment, it's very healthy. And what are your views perhaps going forward?
Well, to dodge the question very slightly, just look at QE. If a country's doing QE, their currency will go down. So right now, we're not doing QE, so we're going up against the dollar, which is doing QE, so theirs is going down. The currency that's been surprisingly strong throughout this whole crisis period is the euro. No one can understand why it's so strong, except it's really obvious why it's so strong. You know, we've diluted our currency to the tune of 25% of GDP. The Americans have now diluted their currency to the tune of 25% of GDP, and the Europeans haven't done any. So therefore, their currency, although their economy is in a worse state, their currency hasn't been diluted, therefore it's risen versus the dollar and sterling. When the Europeans have to start doing QE because their banks are already contracting lending, so they're going to have to quite soon, their CPI growth at the moment, or inflation rate in Europe at the moment is about 1%, maybe less on a trajectory basis. So they're going to be in genuine deflation by the looks of things before the end of the year. So they'll have to do it. So when the Europeans start doing QE, the euro will start a 5-year decline. When the US stops doing QE, the dollar will start a 3 to 5 year bull market. We are currently in the sweet spot. We haven't been doing QE for the last year or so, therefore our currency is going up, but we probably will need to do some. So I would enjoy the cheap holidays you're going to have this summer while you can. Probably the last one, I was showing the 5-minute sign a second ago.
Thank you very, very much indeed for very precise and concise comments. I would just like to ask, despite the extraordinary conditions of the incredibly low interest rates and QE, is it fair to say that we're seeing stock markets performing in the traditional way of that they are leading and anticipating indicators, and that it's better to travel than arrive? And that, would you say that we're likely to see the FTSE 100 perhaps lower at the end of 2015 or about the same as it is now?
I would say that the stock market's doing another role it traditionally does, which is sort of act as leading indicator. And on the sort of better to travel than to arrive basis, the market tends to do better before the economy is doing better. The curse, in a way, if you want to interpret it that way, of the UK is that the economy is doing quite well. So look at the stock market. Nothing. You know, we can't get the stock market to move. Why? Because if the economy is doing well, that'll have a marginal benefit to earnings, which will push down multiples a little bit. But of course, what we really want is multiples to get properly sort of re-rated. And we only get that if we have significant change in bond yields. And of course, what we're really looking at here, if the economy is strong, is bond yields getting higher. So therefore, you know, what the bond market takes away from your stock market, the earnings will struggle to keep up with, especially if it's mainly being done through share buybacks. So, as I said, I think really, whether you look at it in the old-fashioned way or the kind of modern, simpler QE way, you still end up with the same answer. You know, if the economy is going to be weak, we'll need QE. That's good for stocks. If the economy is going to be strong, we won't. And that's bad for stocks. So. I suspect that the economy won't be doing well this year, but by the end of the year, things probably will look on the real economy front a lot worse than the consensus imagines. The prospects, therefore, for further stimulus in the form of QE much more likely. Therefore, by that stage, the stock market might well be looking a better start. But that's probably not a story for the next 6 months or more. I promised I wouldn't make forecasts. There I am, forecasting stock markets. I think that's probably it, unless someone's got a burning final question. No? Fine. That's it then.